French bank Crédit Agricole is cutting jobs and warning it will post a net loss this year. However, the bank says it will meet the 10% Basel III Tier 1 ratio in 2013. Our next guest says the market is telling the banks they need to shore up capital, but where will this come from? We turn now to Stanley Crouch. He's Chief Investment Officer at Aegis Capital. He is in New York. Thanks for joining us, Stanley.
Great to be here. Thank you.
Well, so answer that question for us. These banks in Europe have been told to shore up their capital. There are a lot of things, selling assets and so on, but are they going to be capable to get up to the levels that are required?
Well, there's a couple of issues. One is the capital requirements. They've gone through this latest version of the stress test, although I'm not sure how much you can trust the stress test, particularly over in Europe. I mean, if we hearken back to July or June in the middle of the summer, the stress test was performed, and one of the Belgian banks, Dexia, the largest Belgian bank, passed with pretty good margins, and a few months later they were insolvent and really out of business. So it's really something that was taken over by the Belgian and French governments jointly. But the point is, it's very difficult to tell. Look, the perfect storm has hit the European banks. I don't mean to sit here and be a defender of them, but when we think about the sequence of what happened, they came to the property markets pretty late and in a big way in the U.S. anyway, and I have pretty first-hand knowledge of that. They participated in these different loan facilities. They got sort of really clocked towards the end of the cycle, and then they got recalled back to Europe, and they were told, don't take that risk any longer. Buy sovereign debt, buy high-grade corporate debt. Sovereign debt was considered riskless. High-grade corporate debt, much of which were actually banks' own bonds to each other, were considered low risk and very highly rated. So they're sitting here now with these problems in valuation, and then they've got the knock-on effect from the 2008 crisis, where the capital requirements have been raised in order to stave off the next crisis, but it's almost creating a crisis of its own. So it's really a difficult situation.
So pardon my choice of words here, but basically you're saying a lot of these European banks are holding securities that are just kind of crappy and toxic, and they're in a really bad spot, right?
Well, they've become, I would say, toxic, or at least toxic to some extent. As the rates have risen, as Italian bond spreads and Spanish bond spreads have widened out, obviously Greece is a disaster, but as those spreads have widened, their valuation, the portfolio that had lent to those sovereign credits when those rates were lower, suffers principal losses on paper. So, you know, they're in a very difficult position. I think what needs to happen is more clarity, and either you're going to have to let the market sort this out, which would be a very painful and I think disjointed and disorderly process, or I think they're going to have to come at this with a much larger, I hate to use the euphemism, but bazooka, if you will, which includes a much bigger solution than has so far been put forth. I mean, how many summits in a row do we need to, and how many market reactions do we need to tell us we have a problem?
Well, the leaders over there, Stanley, continue to be behind the markets. Will it eventually play out that the markets will force the leaders in Europe and the ECB to do something bigger to try to get their hands around this thing finally?
I think that needs to come, but I also think that because of the magnitude of the problem, we've got over €1 trillion worth of sovereigns coming due next year that need to be refinanced and rolled forward. We've got over €1 trillion worth of bank debt on top of the sovereigns that have to be financed. And I do not believe at this juncture that the private markets are sufficient to absorb that sort of thing. And I think this has to be a very concentrated effort. Now, Mr. Draghi, just prior to the summit, did come forth with ECB's to the questions. And what they basically said is, we're going to create a special 3-year facility where we'll lend basically at 1% to the banking system. They come in, they borrow, and theoretically they're supposed to buy sovereign debt at a higher rate and effectively have a very nice carry trade going forward. The problem with that is that that's a long-term differential solution. So if, say, you're buying Italian debt at 6.5 and you're paying 1% for the money, you know, that's great. You're making 5.5% positive carry, if you will, but it takes years to kind of rebuild the system back to solvency. If we look at it this way, the credit lines between the banks are really widening. We look at spreads that are in these overnight facilities. Those are very wide and very disturbingly wide. And the deposits of banks at the ECB are very big. There's over 300 billion euro. So that means they don't trust each other, and maybe for good reason. Look at what happened to the equity prices on particularly the French banks today. They really got slammed.
Just to wrap it up here, we're seeing that Credit Agricole has been cut one level to A+ by Fitch. The outlook is stable. Just need a short answer. I'm afraid we're running out of time. Kind of unfair here, but are European banks on thin ice, and will the leaders do anything they can to stop some kind of a real problem?
Well, Fitch just beat S&P to the punch because S&P came out last week, as you know, with reviews of all the sovereigns and a lot of the major banks and put them on this watch for potential downgrade. Now I think we're going to see a rating action pretty soon, probably within the next day, and that could put just more pressure. We need a huge bazooka, and it has to come internationally, and I've said it before, G20, IMF, ECB, everybody has to get together on this. This is a worldwide problem. Make no mistake.
Thanks so much for your perspective today, Stanley.
You're welcome. Thank you.
That was Stanley Crouch, Chief Investment Officer at Aegis Capital.